The question is, will economies bounce back like the market seems to be assuming, and that's yet to be seen. But certainly the market is trading like we're in the hope stage. So these are big numbers and big chunks of the economy that will come back, but there will be a lag. And so we think in that environment, people are going to have to be more thrifty. Businesses like Amazon, for example, where e-commerce and online shopping were trends already, but this has really accelerated those trends. What would have coronavirus been like 20 years ago? It would have been so much more isolating than it has been today. So I think that's been the upside, just seeing everyone's adaptability and ability to use technology to stay connected. Definitely up front, it was getting that separation between home and work and just working out new workflows. What took them 500 days in the GFC, they did in 3 weeks in this crisis. So yeah, liquidity and don't fight the Fed.
Given that we're doing quite well here in Australia and relative to some of our, the overseas markets, US for example, really large market, how does that impact how you're thinking about investing, that relative performance of people dealing with the virus or countries dealing with the virus? Yeah,
look, I think when you look at overseas, it really depends on the market, and say the US, the headline number of cases is very high, and you've got very dense cities like New York where that's seems obvious that would be the case because of the density of living, and then you've got to overlay that with the actual deaths, and the US doesn't look as bad on that metric compared to Europe. So I think, yes, the different economies have reacted differently. They've got different numbers of ICU beds, and hence the number of deaths is different across different geographies. But no one's been left untouched. And look, China obviously went in first and has come out first. And the level of government intervention in an economy obviously plays a role in terms of how quickly you can test people. So I think that's another factor, the level of testing in different geographies. But really, we look at each geography and make a call on where they are and how they're being affected by corona. But even more important is often looking at the sector, because within an economy, particular sectors are actually benefiting and thriving in this environment, whereas others are really struggling, whether that's travel and leisure, heavy capital equipment, autos, trucking. So those sectors are finding it very tough, whereas cloud players like Microsoft and Amazon are benefiting. In the healthcare sector, there's a number of players that are really benefiting. So I think as much as looking at countries and deciding where you want to invest, having a sector overlay and deciding what companies still look great in this environment is another interesting way to look at it.
Yeah, well, let's dig into that a little bit further. I mean, at the sector level, where have you been spending your time, and how have you tilted the portfolio?
So in terms of a couple of sectors that we think will do well, in the next 12 months, I'd say we think healthcare will do well. And if you look at valuations relative to the market, it looks pretty compelling. And you have to go through the different segments of healthcare. It's not just a broad sweeping statement, because I'd say there's some sectors, some parts of the sector like hospitals that are really trying to adjust their businesses to this new reality. But in med tech equipment, in some parts of pharma, we think they'll do well over the next coming period. I also think in the technology space, there are a number of businesses that are really benefiting and will do well. Again, it's going through within the sector and finding companies that you think the valuation is compelling.
It's often in the moment things, you sort of talk about this, people often extrapolate the present a long way into the future.
Yeah.
I mean, on some of those trends that emerge, we talked about flexible working and online retail and that sort of stuff. What's your view on how enduring they're going to be, and what are some of the themes that you think are really going to take hold?
Yeah, I think that's a good point. I think some of the things we're seeing are more temporary. There will be a degree of flexible workplace, but we will still go back. In many cases, you will still go back to an office, and so a lot of the themes will ease over time, and people will eventually come back to restaurants. It might be at lower levels than it was before, but a couple of themes that we think are more enduring. One is around thriftiness. We think it's inevitable we'll go into a recession coming out the other side of coronavirus. And if you look at a number of people that are going to be unemployed, you look at the industries that will have more lasting pain. It's sectors, say tourism, for example. I mean, domestic, we think, will come back quicker than international. Mass tourism is an $8.8 trillion industry, counts for 10.4% of global GDP. And so that's, a big chunk of GDP that's not going to bounce straight back. And the same with the restaurant industry. I think it employs, say in the US, for example, 1 in 10 people. So these are big numbers and big chunks of the economy that will come back, but there will be a lag. And so we think in that environment, people are going to have to be more thrifty. They are going to have to watch where they're spending their money. And so, on that thematic, we've bought the largest dollar stores operators across the US, Europe, so that's Dollar General in the US, B&M Value Retail in Europe, and then in Japan we own the low-cost discount supermarket retailer called Kobe Busan. So we think, there plays on that thematic of inevitable thriftiness that comes through from consumers in the world post-corona.
Trine, you mentioned the R word, recession.
Yes.
And with the word inevitable in front of it. It was actually one of the questions from your shareholders, which was, do you think we can avoid recession? And if not, what are some of the recession-proof companies, or how are you positioning the portfolio to endure that? Could you maybe just go into a bit more detail on why you see the recession coming and just talk about what you've done to the portfolio to recession-proof it?
There are just these big chunks of the economy that aren't going to bounce straight back. You've locked down in many countries, and even in the countries that haven't locked down, you've seen, social distancing implemented. So I think with that and the output gap that has been created, and the concern that we haven't got a vaccine at this point, people are going to be concerned still that there may be a second wave, and everyone's you're going back to looking at what happened with the Spanish flu, and there were 3 waves, and the second wave was worse than the first wave, and so people, even if that doesn't occur, people will worry about that occurring until there is a vaccine developed. In which case, I think there is going to be a large amount of job losses, and 33 million people in the US, some of those will come back because they are more temporary, but some won't. And I think there will be a hole, and there will be a recession, a global recession. And governments have thrown, and central banks have thrown what they can at it. But they've solved the liquidity issue. They haven't necessarily solved the solvency issues that will come about. So, in my view, we will have a global recession, and there will be countries that come out quicker and that are better positioned. But it won't be an easy operating environment.
And at the portfolio level, talk me through recession proofing. Like, how have you thought about doing that? Yeah.
So in terms of the portfolio, I'd say the characteristics of the companies we've chosen, we've really looked at earnings resilience. We've looked for companies with really sound balance sheets, really high quality management teams, and strong market positions. And the piece that is harder in this kind of environment is working out what actually does have earnings resilience, because when the economy is good and companies and countries are growing well, you can hide a lot of ills, and you don't see the cyclicality that is inherent in a lot of businesses. So we've done a lot of work analysing businesses through prior crises and worked out and to come up with stocks that we think will do well and will be resilient. And some of those sectors is things like the dollar stores, where you don't have a job, so you're going to try and save money. Other areas that we think would, consumer staples companies tend to do. They're very defensive. They tend to do well in this kind of environment, and then auto parts retail. When you're cutting things, you are still going to get your car repaired. You won't buy a new car, but you will get your car repaired. Home improvement tends to be quite resilient relative to, obviously, more you buying another handbag. You fix your house, I think
the run on Bunnings has been incredible.
Well, exactly. Corona, I think, unfortunately, no sport on TV, and Corona has meant a lot more. There's a lot more handiwork getting done.
Yeah, or not so handy.
Yeah.
In the world, your investment universe, there are some truly outstanding, absolute global leaders.
Yeah.
A crisis like the one that we've had, a lot of things get marked down, and some of those stocks that may be on the wish list become attainable. Did you have a wish list, and were you able to pick off some of those bigger names? Because I know you tend to hunt in the small cap world.
Yes, yep. So absolutely, we have a wish list. So inevitably, when you're seeing hundreds and hundreds of companies a year, you'll often come across businesses that are, multi-year growth stories, great management teams, strong dominant market positions, high returns on capital, but the piece that's missing is often valuation. And so you have your wish list of companies that you'd love to own if there is, a market correction. So yes, we have a wish list, and in the sell-off in March, there were various of those sort of businesses that sold off, 20 to 40%, and we were able to add a few of those names, particularly in the larger end of the market, because with all the uncertainty, we did want to keep liquidity, because who knows in terms of exactly how this plays out. So you want some liquidity to be able to raise cash if things start to get significantly worse. So yeah, we did add a few of those names. We added some Microsoft, some PayPal, some Visa, some Adobe. So wonderful businesses. Hadn't necessarily ticked the box in terms of valuation, so we were able to add some of those in the downturn. A few of them we've trimmed now because they've had phenomenal runs, but we're also overlaying at the moment the uncertainty, and there has been some new winners, businesses like Amazon, for example, where e-commerce and online shopping were trends already, but this has really accelerated those trends. So what were already winners have become even bigger winners, and it's the same for businesses like Microsoft, like the cloud businesses of both Amazon and Microsoft, are just doing phenomenally well. And I don't think that's a trend that's going to slow down.
What's happening in the small cap space? Is that now the new opportunity set for you?
Yeah, definitely. So we tend to love small mid caps because there can be a lot more inefficiency at that end of the market, and you can often get businesses that really do have long runways of growth because they just haven't captured all of the opportunity that's available to them because they're often younger in life. So yeah, that's a very a key hunting ground for us for ideas, and we have seen a number of stocks in the small mid cap end of the market come up as interesting, and for example, the number 3 toy company, Spin Master, Canadian listed, fell 75% from December to March. We didn't own it, but we knew the stock, we knew the management team. We were able to buy it on single-digit PEs, and yeah, it's gone up significantly since then. So yeah, there have been some great stocks in the small mid cap end of the market. HelloFresh was a business we'd bought last year, but meal kit delivery company, clear beneficiary. We already owned it. We knew the stock, knew the management team. When coronavirus hit, we thought it'd be a key beneficiary, and we're able to add some more of the stock, and it's gone from 16 to 38 euros in very short order, and still growing phenomenally well. So there've been some names like that. In the more mid-cap end, we added some Activision and EA, which are in the video gaming space. We thought, clearly with everyone home, we thought video games would see a nice boost in terms of engagement levels, and so we were able to add those names. And we've seen in the recent results in the last week or two, very strong numbers delivered.
One of the other things that people are really keen to understand is what happens to supply chains in the wake of what's happened.
Yeah, I think it's 80% of US pharmaceuticals are produced out of China, and 97% of antibiotics come from China and India. So there are some startling figures, and I think what coronavirus is highlighted is just that reliance and the risk around that. And I mean, firstly the tariff, tariff war, so the China-US trade war that really highlighted that dependence on China. And I think then now we've had coronavirus, where you've had issues with getting ventilators, with getting personal protection equipment for doctors and nurses, and that, like, those critical supply, that's not a nice situation to be in when you can't get those crucial medical supplies. But I think it has highlighted to businesses more widely that they do need to think about diversifying their supply chains, and I think inevitably you will see companies push to make sure that they aren't just purely reliant on places like China. And I think that does lead to advantages for some of the bigger companies that have the capital to diversify. If you're a smaller business with only capital to put a plant in one spot, then that's going to be tough. Yeah. And I think it does give advantage to capital-light businesses that aren't reliant on putting capex in all different markets around the world to grow. So whether that's tech companies that can obviously expand quickly without needing capital, or automation firms will benefit, because as you bring manufacturing and production back locally, labour is a big differential between emerging markets and developed markets. So you need to automate to take out some of that cost differential. So I think they're both it'll be an interesting realisation coming out of Corona and out of the trade wars, that we do need to have diversified supply chains. And from a portfolio perspective, how we think about that is, it's like you look at the leverage of a balance sheet for any company that you look at. You will look at where the supply chain is, the risk around the supply chain, and whether you can gain advantage from this situation, or whether you'll be at a disadvantage.
And is that an investable theme, or is it just a bit too early?
Look, I think it's investable in respect to finding capital-light businesses at this point in, say, the tech space. I think from the automation names, some of them are very cyclical, so you've got a bit of time as they wear the pain of Corona today. But yeah, over the long term, they look very interesting.
What's the cash level in the portfolio at the moment? I know on the last investor call, it was relative, not fully invested, but I think sub 10% in cash. Whereabouts is that sitting at the moment? How are you thinking about that liquidity in that cash position? Yeah,
so the cash at the end of February was about 10%. Through March, it went up to 19.5%. Today, it's about 16%. So higher relative to 31 December, but not at any extreme level. And we're cautious, because there is a lot of uncertainty at the moment, but we're able to still find ideas. We're just being very selective on what we're buying, and really choosing those businesses that we think are very resilient, whichever way, whether we get a U, a V, or a W-shaped recovery, there is uncertainty, and it will depend on, at what point we get a vaccine, how quickly economies rebound coming out of lockdowns and general social distancing requirements for different economies. So yeah, we've just chosen to keep the cash, slightly higher than it had been, but focus on those businesses, as I said, that have resilient earnings, strong balance sheets, and we think will weather whichever outcome we get in terms of the bounce back. We appreciate how tough this time must be for all our shareholders, the uncertainty that everyone is living through. We're diligently working on the portfolio, really focused on trying to generate strong returns for shareholders, and appreciating that it's not an easy time for them to be living through at this point.